Hi everyone, hope you're all doing well. Today I'm going to talk about three stocks that were highly requested in yesterday's video, and I'm going to spend a minute or two talking about Fiverr, Inmode and SoFi for you guys. So I hope you enjoyed the video. For you guys that asked to talk about these three stocks. Briefly before we talk on these three stocks, yesterday the market was a little bit rough. You see the S&P 500 opened up about break even on the day, and then as the day went on it sold off. There was a little bit of recovery towards the back end of the day, but it was still down 1.16%. It was actually down nearly 2%. It was getting towards the 2% mark at the worst part of the day. So a little bit rough here as the market braces for the Fed interest rate hike that they're going to more than likely do. Obviously the key commentary today about future rate hikes will be what is key around here. Obviously it looks like we're going to have an interest rate hike, and it looks like with the information that was given on the leaked video from Jerome Powell when he was talking to the Russian TV or the YouTube channel that was pretending to be a Ukraine official, it looks like the Fed are very keen on hiking up their interest rates, still keeping them high up for the whole year and actually trying to force a recession, which is obviously not good. We talked about that. That is, for me, one of the worst new information that we've got in the last few days that makes me a bit nervous as an investor. Saying that, I'm not going to change my investing strategy off Jerome Powell and interest rate hikes, because looking at how the economy has performed sometimes in high interest periods has actually been okay. The only issue is that it could affect the stocks a little bit more in the short term when we have some opportunities once again, which I think we won't mind. I think we wouldn't mind some opportunities in the stock market, because we have had a bit of a rally recently in the start of 2023 where there has been some opportunity to make some money. It's just a little bit annoying to see that happen though, I guess. So getting on to, first of all, Inmode. Inmode is down 10% today. Major move. And the worst thing is, like, for me, because I've been in this stock for so long and I'm up on this position so much, a 10% move for me is actually a lot bigger on the position size because of how much I'm up on the position. So this stock got hurt massively. I think I was up something like 85% or something today, and the drop that I had from that position, it was absolutely crazy. So I've owned this stock for 3 years. I started buying this around June time in 2020, as any of you guys that have been following the YouTube channel for the last 3 years, and shout out to you guys that have been following the YouTube channel for 3 years, and thanks so much for the support. You guys that have been following for 3 years will know I started buying this in June 2020, being one of my best performing stocks. It was a stock I was actually up over 400% on at one time, and we did take a little bit of profit off the table there, but I still held a lot of shares because I think in the long term I'm still very excited where this company will go to, and I do believe this company will be able to break that $100 barrier in the next few years after we've got past the bear market. Obviously it's had a bit of a reality check as the shares did come back down, but for me, I took that as an opportunity to just increase the position as much as I can really and buy some more shares, and I'm still set up on the position. Obviously since that time frame the stock is up 122%. Like I said, for me, I was up 85%. I believe I'm up 60-something% maybe after today. Obviously took a bit of a beating, but still up on the position, and I'm not going to moan too much about an opportunity to buy some more shares at a cheap valuation for this one. And just a bit of I'm just going to share a story here if it's okay with you guys. I mean, you haven't got a choice really because it's my YouTube channel, but yeah, I mean, I was talking to someone, another long-term investor. I was doing this a couple of years back. It's something that always stuck with me. And he said he was on about day trading. And obviously, you guys know I'm a long-term investor. I'm not really interested in day trading. But he said that he's actually spoken to some successful day traders, and he always said, like, quite often being a successful day trader isn't really looking at lines on charts and where they're all going. Most of the time it's actually understanding your stock. If you actually understand your stock, you'll actually be able to sense some moves that the company kind of makes, and you'll be thinking, well, what do I mean by that? Well, when you actually look at, if we zoom out a little bit, basically the stock hasn't really done much since summertime. This stock is basically flat really since summer. But in that time frame, there has been moves up and down. And most of you guys that know Inmode and have followed Inmode for 3 years, you'll know what I'm about to say here. This company has a history of pre-releasing earnings. So the pre-release earnings, when the pre-release earnings, the stock normally goes up on those earnings, and you can roughly get the date they're going to pre-release earnings from last year. And then they actually bring out their full earnings with the conference call, and the stock historically drops on, and you can see the drop here today on the full earnings. And the more that you kind of know stocks and how they move, there'll be certain stocks that you'll probably be able to know this off. Is that Inmode is a stock that has historically done this move. It's historically pre-released its earnings, stock goes up, and then it brings out its proper earnings, and then the stock goes down, which is absolutely crazy. And the information that came out today is no different from the information that actually came out on the 12th of April. There's not really that much difference, and it's crazy that the market sends this stock up to, on the day, $37 or whatever it was, and then the same information can send it down to $33. But yeah, I mean, the numbers were really good. There were no shocks. Obviously, if we look at the preliminary earnings, that gives it, because when we actually come to the actual consensus, these aren't great reflections on what the actual market was expecting. If we look at the preliminary results, you can see here that Q1 revenue was going to be in the range of 105.7 to 5.9. The consensus was 100 million. That was a major beat. GAAP EPS was in the range of 50 to 51 versus the consensus of 0.46. Gross margin is basically what we're expected. And maybe what spooked the market a little bit is the revenue guidance was sandbags, which they do historically do. They sandbag guidance and then absolutely smash it, which is absolutely fine. But I can't see why a $0.01 on the EPS and revenue being basically 0.7 million below the consensus would cause a 10% drop. It's absolutely crazy. Maybe it's some of that negative market that really did affect something like an Inmode today, and that what did really push it down. But this is absolutely crazy. I mean the company's trading at 14 forward times earnings. 14 forward times earnings for a company that just came off that EPS beat, that revenue beat, 23% year-over-year growth. Amazing balance sheet. Probably too good of a balance sheet. Like, they should start doing some things with that cash. That would be ideal. One of the big issues that I've always had with this company is that they don't have recurring revenue. The recurring revenue growth in this quarter was absolutely insane as well. It's just crazy. It's crazy. Like, this company here is financially arguably the best company that I own, and the valuation. 14 forward times earnings. There's no risk of what is profitability going to be. Profitability is here. The balance sheet is here. The growth is here. There's no oohing and ahhing about the valuation or what the valuation or what profit it can be. It's insane. The only issue I've ever had with Inmode is that it's too good to be true. Like, this company here that's doing these numbers should be over double on what it is today in a bear market. You should be talking 30 forward times earnings for a company like this. It should be double the valuation. And the only reason that makes me nervous is that it's too good to be true. This company is insanely cheap, and it's obviously insanely cheap. And that's the only issue that I've ever had with it. So, I mean, I've had that issue for 3 years, and it still carries on smashing it. So, yeah, crazy opportunity. If you haven't looked into Inmode, I would have a look into it. And that goes on to the next one, SoFi, a bit of a fintech platform. Now, this stock, once again, got really dragged down today, 10% down today, nearly as much as Inmode. But this stock actually dropped as well on Monday after it brought out its earnings. So you can see here the stock dropped nearly 15% on Monday. Top that up with Tuesday's drop, and then you've got the stock down nearly 23% in 2 days. Can you imagine that? You're losing 25% of your company's value in 2 days. And SoFi is a company that's always interested me. I've never really bought just because I'm already fintech heavy. I've already got the likes of Square in here. Square's a bit more different to SoFi. Square's a bit more business focused. It does have a bit more of the personal cash side of it with the likes of Cash App, but definitely more on the business subscription part of the business. That's what it's mostly focused on. SoFi is obviously more around the personal kind of finance space compared to Square. Visa, which I guess is more obviously swiping and tapping and taking money from that point of view. And PayPal is obviously more sending money. So SoFi would actually be different to the stocks that I currently do own, but I am already quite fintech heavy. That's the only thing. And obviously you would expect a recession, if we were to hit one that was forced upon us from Jerome Powell, you would expect all of them companies to get hurt a little bit. And that's the only thing that I still consider with if I was to buy something like a SoFi. But I was looking off their earnings, and their earnings that actually came out on Monday were insanely good. Like they were really, really good. I mean, I'm going to have a little bit of a look again just to see if there's any red flags. The only reason I can see that the earnings did drop is basically the guidance being weak, which a few people are saying, but it still looks really strong to me. And the potential of the loan increasement and the default in loans, especially if we hit a bad economy, which ties into what I was saying a little bit earlier. But even then, like, it looks very well diverse in case of that situation. So I don't see both of those risks why it should have caused a 25% dip in this one. Revenue, 43% year-over-year growth. Absolutely crazy. Adjusted EBITDA stood at 76 million, a 16% margin, which was at the higher end of the 40 to 45 million of the previous quarter. We'll talk about the losses in a second, actually. Outlook is the key thing. So you can see here the revenue was in the range of 470 to 408 million, the consensus of 463. That was obviously really good. Adjusted EBITDA is to be in the range of 50 to 60 million. And for the financial year 23, it raised its adjusted net revenue guidance to the range of 1.9 to 2.02 versus the consensus of 1.97. The prior guidance was 1.925 versus 2 billion, so a little bit of an edge up there. That's what I'm saying. Maybe the Wall Street didn't like that. Adjusted EBITDA is estimated to be between 268 million to 208 million from the prior guidance, once again, of 260 to 280 million. And originally, as you can see here, the shares was actually up on the day after they brought these out. Now, digging just into the numbers very quickly once again, obviously the growth was very good, but this is the other really impressive thing about SoFi at the moment. Look at the losses. They are growing at 43%, and the losses, that is a major drop in losses. So you're driving here, revenue's up at a really good rate still, and you're not sacrificing anything on the bottom line. That bottom line is moving to profitability. Also, sales and marketing declined, so none of this revenue is being funded by sales and marketing, which is insanely good. That's what you really want to see. None of this growth is funded by the cost of the company. They said they're also going to aim for GAAP positive income in the fourth quarter of 2023. That's crazy. So you're talking about a company that's going to be very close to break even. Obviously, that's on a GAAP basis by the end of this year. That was one of my major worries with SoFi. And then just have a look at the growth. I mean, the company hasn't got one income stream. I always like companies that have multiple income streams. And look at this, they're attracting new customers on the platform, and then all these customers are using more and more individual products. You've got the invest account, the credit card, the referred loans. Obviously, this is what I think might spook people, is the growth of these products. The relay up 98%, at work up 71%. You're looking at all this growth here, and you also got to take in the consideration about the student loan situation as well. It looks very, very interesting at the moment. So I was always one that I just didn't think SoFi was a good fit for my portfolio. But I was looking at like the levels now that of adjusted EBITDA they're going to start throwing off, how close they're going to be on a break-even basis, the free cash flow they're throwing off. And at 4.5 billion, I was like, you can see there is a little bit of a risk to reward here, where it's like, do you take a little bit of a, back at nearly 52-week close after these earnings, there wasn't really any major concern. And today it looks like, one of the big reasons why the share price has run lower is because of Wedbush. They said that they turned neutral because the outlook was only raised modestly. You can see here that they weren't happy that even though they beat massively, they didn't raise their guidance, and that was a reason to downgrade the company. And they cut the price from $8 down to $5. I mean, I don't know. I was like, that seems crazy to me that this is causing such a drop in here just because they didn't raise their guidance enough. I think the numbers there are speaking enough, and even if it was a little bit of a drop down here, that's absolutely crazy. So I don't know. I think that could be a little bit of an opportunity, even though it's not one I want to take. There's a point where you go, is it worth just throwing a bit of money in here and thinking that, when you look at the risk to reward here, it is tempting. So I don't know. I'm having to think on that one. And the next one's Fiverr. So Fiverr was down nearly 15% today. Fiverr is a company that I actually use Fiverr, and I think the Fiverr platform is fantastic. The only problem is that the platform and the stock are two different things. I really, really do like the company, but the stock has been a different story. If the stock was ever to get to the right valuation and put in the right financials, I could buy it, but that unfortunately hasn't happened. Now, the reason why Fiverr dropped is to do with Chegg, a bit of an education platform. You can see here it was down 50%. Now, basically, they brought out their earnings and they said that they have seen ChatGPT affect their stock. And the worry is that, or their company, the worry is that Fiverr is a company that could also get affected by this AI growth, which I think is massively overdone at the moment, a lot of this AI talk, but hey, it is what it is. Now, I don't know why. I'm not a big fan of when other companies get dragged down because another company said this. Like Chegg brought out these earnings and they said, oh, they were really bad because of this issue here. Well, when you brought out earnings on the last quarter on February the 6th before the whole ChatGPT thing skyrocketed, your earnings were weak last time and your stock dropped 20% and you didn't mention that issue last time. So I always think sometimes like a company looks for something to blame. It looks for something on why they're doing a bad job rather than actually going, yeah, we're doing a bad job. Like sometimes companies seem to do that, and I think that's what's going on a little bit here. Now, it might be affecting them a little bit, but realistically, it's not the main cause of why the company is doing pretty bad here, as you can see in the last quarter. So I think this is a bit of a overblown sell-off in Fiverr today because of something that's out of their hands, but it is worth considering that it could be a little bit of a risk going forward, the ChatGPT factor that is. But it seems a little bit overblown on the share price drop today. Now, the reason why I personally can't buy Fiverr isn't because of Chegg, it's not because of ChatGPT. There's another reason why I can't buy Fiverr. The reason why I can't buy Fiverr is this: it's unprofitable, which it's got good gross margins. I think they can get to profitability if they could ramp up a lot quicker. The problem is that you're buying this company and it's a bit of a premium company, and you're only picking this up for 4.2% revenue growth off the last quarter, which isn't good enough. This company isn't profitable. It's supposed to be in its kind of hyper growth stage, and then it only offers you 4.2% revenue growth. And to put that into context, it's currently a 3.39 price to sales ratio. There's not many metrics we can use on them being obviously an unprofitable company, but like to compare that to something like a SoFi, for example, I think SoFi today, that dropped somewhere to the lines of like a 2, maybe even into the high 1 point something. And you're looking at the growth that you get in there and the move to profitability for that sort of company, and you compare that to something like a Fiverr that isn't really offering you that kind of growth at the moment. And if you look at the revenue here, the revenue was 83 million, they throw 67 million gross profit. That's obviously really good. But the problem is that research and development is 21 million, sales and marketing is 40 million, and G&A is 7 million. So they actually make an operating loss, you see here. Now it's close to break even, but the problem is that the costs are so high, and like, is this just too much of a competitive area where they're having to throw so much in R&D to stay ahead? The marketing is crazy high, and if they're not increasing the marketing, is that why there's no growth? And when you look at Fiverr, prior to the CV situation, they've had a boom on the CV situation that's dragged a lot of revenue forward, and I think that's a bit of the balancing out acts that's going on. If Fiverr went back to what it was doing previously, before the CV situation, if you look at the revenue in financial year 2019, the revenue in 2019 grew 42% from 2018. So this wasn't a company that just boomed from the whole CV situation. Before the CV situation, it was growing rapidly as well. But since the CV situation, the growth has just gone absolutely flat on the business. And this is the big issue here. So I need to see the company go back to high amounts of growth that isn't funded by sales and marketing. And then because of the scale, they'll turn profitable and the growth will be really good. But at the moment, I've not seen Fiverr do that for a very long time. And that's personally why I haven't been able to buy the stock at the moment, is because of those reasons. If it was a company that was driving up the profitability, it was driving up the revenue growth like how it was doing previously, while not increasing sales and marketing, I could buy Fiverr, but at the moment it just seems to be stuck in a rut with no growth at the moment, and I don't know if that's just because of all the demand pull from the CV situation and it will get back to growth at some point, or there's just so much competition out there now and people have kind of caught on a little bit with Fiverr. I don't know, but at the moment the financials have just never been where I'd want them to be to buy this company at the moment, and it's a bit annoying because I do really like the company. I like the company, but unfortunately the financials and the stock, the price of the stock and the financials aren't there where I would want them yet, which is frustrating because I do really like the company itself and the service. So yeah, I've got it on a watch list, and if the financials do ever improve on Fiverr, you probably would see me buy it, but it's far from that at the moment, which is the issue, I guess. So yeah, hope you enjoyed me looking at these free stocks anyway, guys. I know they were highly requested, so don't let me down, and make sure the views are okay on it, and smash the like button as always, guys, and I'll catch you in a bit.